Very good morning to Dr. Lin. My name is Doris Siu and I'm from Tutorial Group 4. So today I will be presenting about this assignment 2A, case study in global trade and foreign exchange. I will choose test 3, which is tourism, impacts of COVID-19 and a volatile Australian dollar. Next slide. The COVID-19 epidemic has shattered all private development narrative. Worldwide, governments have implemented lockdowns on a higher scale ever since to try to stem the spread of the virus. Nearly half of the world's population has imposed unprecedented limits on travel as a result of this epidemic, which may have a significant impact on many elements of business and society, including the tourist industry as a whole. Thus, due to this COVID-19 pandemic, tourism cannot travel anywhere, and thus this definitely will affect the tourism industry. Not only that, the Australian currency will also be affected by this pandemic. Several domestic and international variables impact the currency rates. Terms of trade and interest rates variations between Australia and other advanced countries are two important factors that influence the Australian dollar's value. Australian dollar depreciation has been caused by a decline in trade conditions and monetary policy relaxing since mining bomb's conclusions, including the recent implementations of quantitative easing measures. Similarly, the Australian dollar has reacted to shift in global risk perceptions by following the price movements of other international financial markets. A trade-weighted TWI basis, the Australian dollar has declined from its peaks in 2013 following the conclusions of the mining bomb. While the interest rates in the United States and Europe have stayed low, monetary policy in Australia have been loosened. As a result, the gap between Australia's interest rates and those in the United States, Europe, and Japan has narrowed, even though commodity prices have fluctuated greatly in recent years. Australian terms of trade, the ratio of export to import prices, graph 1, will show in the next slide, have decreased since the top of this mining bomb. The Australian dollars fell to its lowest levels since the early 2000s during the COVID-19 outbreak phase in March 2020. However, despite these positive developments, the Australian dollar has remained significantly below its 2013 top as the outlook for global growth has brightened and commodity prices have risen. This one is the graph 1 about the Australian dollar. Over the medium to long term, the Australian dollar's value is heavily influenced by the terms of trade and interest rate differentials. These factors help predict the demand for Australian dollars in the future. This is reflected in the demand for Australian dollars. For example, as a result of a difference in interest rate between Australia and other nations, there are several exchange rate models in use by the Reserve Bank, including a forward-looking model for the Australian dollars. These correlations have been observed over a long period of time. This model calculates the real TWI, RTWI based on past association with the Reserve Bank expectations for the terms of trades and information from various maturities throughout the real yield curve in Australia compared to the main advanced countries. The Australian dollar's levels has mostly matched the model's predictions based on these fundamental factors. Graph 2 will show in the next slide. Although the correlation persists, the Australian dollar has diverged substantially from what these variables suggest at times. The associations are not exact. Global financial markets, such as changes in investor risk perceptions, can impact the behavior of market players from time to time. There were times when the COVID-19 outbreak in March 2020 led to an increase in RTWI depreciations that was more than what the long-term model predicted. So this one is the graph 2, equilibrium real TWI. So the recent COVID-19 pandemic also showed the short-term Australian dollar swings may be particularly rapid during situations of heightened financial markets volatility and risk aversion. During these periods, demands for safe haven currency like the US dollars tend to surge, which causes the Australian dollars to decline. Unwinding carry trades in volatile financial market can worsen the decline of currency exchange rates. And investment strategies known as carry trading often includes borrowing money in a low-yielding currency and investing it in an asset that is expected to earn a higher return, such as gold, such as the Australian dollar. Because even a modest fall of the Australian dollar may make the carry trade unprofitable for investors, it has historically been a major driver of the Australian currency, at least occasionally. Australian exporters benefit from a weaker currency by seeing their comparable prices for products and services produced in Australia drop. There will be an increase in the amount or quantity of Australian export, since Australian goods and services have gotten cheaper in comparison to abroad goods and services. Imported products and services are also more expensive for Australian consumers and business following a decline in the exchange rate. As a result, Australians are likely to alter their spending habits to seek more Australian produced products and services, resulting in a drop in import. Tradable commodities and services are primarily affected by changes in export and import prices, resulting from a change in the exchange rate. Non-tradable products and services can also be affected by changes in the currency rate. Export will rise and imports will fall as a result of a depreciation, resulting in an increase in Australian national revenue. As a result, demand for Australia-made non-tradable goods and services will rise. Australian businesses will need to hire more employees to match the rising demand for their products, which will result in more people finding jobs and reduce unemployment rate in Australia. Due to the travel limitations, the number of tourists to Australia has decreased significantly. Prior to the epidemic, China was the primary source nation for travelers to Australia. Around 1.8 million tourists came in Australia in 2020, a decrease of 80% from the previous year and the lowest level since 1987. New Zealand received the most visits, 242,500, followed by China, 207,700. The majority of travelers came on vacations and stayed for around 14 to 15 days in Australia. During this pandemic, the highest number of citizens entering the foreign nations also declined. The following table summarizes the number of visitors visiting Australia from the top 10 nations. April to May 2021 had an almost 98% decline in travels compared to April-May 2019. The majority of passengers, 60%, were returning Australian residents from New Zealand. The most popular vacation destinations in terms of other nations, visits from the top 10 countries decreased. This includes a 126.2 times decrease in the number of passengers from Malaysia, followed by a 74-time decrease in the number of travelers from China, 60.54, the United States 52.6, India 44.4, the Philippines 26.4, the United Kingdom 21.4, South Africa 11.1, New Zealand 2.9, and Vanuatu 1.8. However, this may not accurately reflect the true impact of passengers due to the fluctuating number of travelers. So this one is the top source country citizens' arrival to Australia during 2020 to 2021. The effect of COVID-19 on tourism and associated unemployment. Tourism in Australia has been drastically diminished as a result of interstate and international border restrictions. Due to a decrease in the number of individuals taking vacation, the tourist sectors has suffered significant revenue and job losses. There were 662,700 tourist employment in March. This was 3,100, 0.5% more jobs than in December 2020. 35,500, 1.1% less employment than in March 2020, and about 1 in 20, 4.7% fell in the jobs in the economy. This one is the change in the number of jobs in Australia during COVID-19. To curb the development of COVID-19, Australia established substantial social distancing measures as well as other business-related limitations such as working from home, office utilization limits, number of persons per square meter, travel restrictions, and prohibitions on group activity. The government also introduced assistance programs such as JobKeeper and JobSeeker to address rising unemployment rates and job losses. According to the important statistic projections for May 2020, the unemployment rate rose to 7.1%, while employee participation fell to 63%. The underemployment rate fell to 13.1%, while monthly hours worked fell to 1,605 million hours. The unemployment rate grew by 0.7 PTS to 7.1, 1.9 PTS more than a year earlier, while the number of jobless increased by 85,700 to 927,600, and risen by 219,200 over the year to May 2020. The young unemployment rate rose by 2.0 PTS to 16.1 PTS and rose by 4.1 PTS in the year to May 2020. The young employment fell by 227,700 person, 1.8% to 12,154,100. Employment grew by 987,200 individuals in the year to May 2021, 8.1%. Furthermore, employment was 130,400 individuals, 1.0 greater in March 2020 than in March 2019. Similarly, full-time employment rose by 97,500 to 8,965,200 individuals, while part-time employment rose by 17,700 to 4,160,000 people. Part-time employment was 31.7%, 0.1 PTS lower than in March 2020, and 2.1 PTS greater than this time last year. Next is the recommendation actions for the government and policymakers. As the COVID-19 crisis management unfolds, countries are adjusting policies to address gaps, the needs of tourism business, while others are beginning to plan comprehensive tourism recovery plans. Many policymakers are looking at the long-term effects of the crisis and structural changes that will be required in order to build a more sustainable and resilient tourism economy in the future, even as they are focused on protecting workers and visitors in recent months. Policymakers' decisions will have a significant impact on how the tourism industry develops in the years following COVID-19. Even immediate crisis response is no longer needed. Beyond the immediate remedies needed, policymakers will need to learn from the lessons of COVID-19 crisis to develop crisis management procedures to better equip destinations and the sector more broadly to adapt the future shocks. As the situation depends, governments are devolving resources to enable a quick recovery following the catastrophe. As recovery strategies are being established, government recognize the following categories as significant objectives and challenges. Rethinking of the tourism sector, the crisis gives a chance to redesign the tourist system for a more sustainable and resilient future. Policy intervention will be important to solve structural difficulties of the industry, avoid the return of concerns of tourist management, and promote key goals, such as fostering new business models, embracing digitization, and increasing connectivity. The latter will be of major relevance in and after crisis situations when social alienation will be still prevalent and visitors will return to less congested venues. Sustainability should be guiding concept in the recovery, including with the objective to reduce tourism as a vector of pandemic. Rebuilding destinations and the tourism system. Support and rehabilitation strategies need to be brought throughout the different branches that make up the tourism experience. Accessibility, connections, and transit should be high on the agenda equally as lodgings, restaurants, resorts, events, travel associations, travel tech businesses, tour operators, and tourist groups work to construct strong and attractive destinations. Over many years has been wiped away in a fraction of the time, and recreating this will be a critical endeavor to maintain local economies. So this one will be the references. So that's all from my presentation. Thank you.